Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
What's the best option strategy? I get this question, every time I give a seminar or webinar. What's the best option strategy? Well, there isn't any. I mean, if we would have known early on in 2008 that the dollar was going to be so strong against most of the majors, buying calls would have been the best strategy. Now, if I would have bought calls in, let's say, October or November, probably would have lost a lot of money because the dollar had already rallied so much. Maybe puts would have been the right strategy at that time. Again, there isn't any best strategy. You want to think about what you feel comfortable trading, what kind of asset, is it an equity, an index, an ETF, or a foreign currency? And again, what kind of option strategy? Well, it's going to depend on your own financial goals and your own risk tolerances. There isn't any one best strategy, and the strategies are going to outperform and underperform from time to time. So you want to select strategies that you feel are most compatible with your own sort of makeup, your psychological makeup. So how do I manage these positions? Well, financial success may depend just as much on managing both your winners and your losers, and I think we've all learned that in 2008, that we need to think just as much about managing losing positions as managing winners. If you had a portfolio that has many positions that are all expected to move in the same direction, that's just great. If you knew that it was going to be the right direction, but we don't know that. So again, you may want to consider diversification so that you have some winners and some losers that are balancing each other out. So that's really my message here, is that diversification is something you may want to consider. 2008, very challenging year for the overall market, but if you were trading the ICFX options and you were long the U.S. dollar, well, you could have mitigated some of those losses. Individual equities can and do move much further up or down rather than ETFs. So think about WorldCom, Enron, 2008 financial stocks, internet stocks. Individual stocks, even some sectors may not revert back to their previous price ranges. So the third bullet is something that I want all of you to think about, because the option pricing model is based on the thought that assets are going to revert back to some mean, and they may not. And we all know assets that are not going to revert back to that mean because, for whatever reason, the market has changed, and the mean is going to be, the current price may move marginally one way or another, but it's not going to go back. When you see assets are down 95%, they're probably not going to go back up 95% in a very short period of time. Groups of stocks are going to tend to balance themselves out. And again, that message is called correlation. I'm seeing some questions roll in. I'm going to try to answer all your questions at the end. So correlation, very interesting. So what is it? Well, with the goal of diversification in mind, you want to try to think about how assets, if they're all moving in the same direction, that probably isn't a good thing, because let's just say you had all oil stocks and you bought them all in July or August. Well, that probably didn't work out very well, as crude collapsed, and you would have had a portfolio that was probably down significantly more than the market itself. So again, that's really up to each individual investor, but you want to think about correlation. Without an extensive amount of mathematics, one definition is the strength of a linear relationship between two variables. A more practical one is really how an asset moves in relation to another. For correlation to exist, the relation must be somewhat linear, or the variable must have some effect on the other. Perfect correlation would be 1. A perfect inverse relation would be -1. So the efficient market portfolio states that rational investors should seek to buy undervalued assets with low correlation with your existing assets. An example with a high negative correlation is commodities to bonds. So that's why some of us like to buy bonds because they should do well in periods of time when interest rates are coming down. And again, it depends on the bonds that you're buying. Corporate bonds may act differently than government bonds. Normally, bonds do poorly during periods of inflation, but commodities are going to do well. So foreign currencies have traditionally shown low correlations to equities and bonds. Considering the versatility that the listed option market provides, investors may want to consider some of their favorite option strategies in the ISE FX options market to reduce their correlation risk. So correlation, assuming you have an overall favorite option strategy, even though we may not know, we do know that your favorite option strategy isn't going to work all the time. We don't know when it's going to work, but if you understand money management and the idea of risk reward, you may find some opportunities that are compatible with your own goals and risk tolerances. So most equities and ETFs are lower in price in 2008 versus 2007. Equity volatility is generally much higher, even though we've seen a huge decline in volatility in about 3 weeks. That doesn't mean that we couldn't see a ramp back up in volatility at some point in 2009. FX volatility down quite a bit from its high, but it's probably somewhere in the mean of the last year, as we saw very, very low volatilities at the beginning of 2008, very, very high volatilities in the fall, in October and November. So again, what's the dollar done? So you'll see that yuck is down 19%. Excuse me, that's the U.S. dollar against the yen. So the dollar is down against the yen and the Swiss franc. And that symbol for Swiss franc is SFC. That's the dollar against the Swiss franc. And then if we look at the other four, British pound, Canadian dollar, Australian dollar, the U.S. dollar is up quite a bit against those three and up marginally against the euro. So you'll see that there on slide 50. And that is, of course, the performance in 2008. What's going to happen in 2009? Well, it's nice to have a theme. In fact, I remember going to a presentation where somebody actually predicted that the yen would strengthen in 2008. But again, early in 2008, the yen wasn't necessarily strengthening all that much. We saw most of the strengthening in the last part of 2008. Interesting, volatilities. So ISE FX implied volatilities. You'll see the low. Look at those low numbers. I mean, it's incredible when you think about volatilities that were in the single digits in every pair on its low in January, February, and at their highs, you see tremendous volatilities. And of course, the highest volatility right now is the Swiss franc, followed by, the euro is actually just a bit higher, but it's not trading at its high. The Canadian dollar is also, but Swiss franc's actually trading at its yearly high. So the lowest vol right now is actually yuck, or dollar yen, which is interesting because I would have actually thought that it would have been higher than that. But so we've seen the dollar actually come back a bit against the yen, reducing that volatility. And I would love to answer any questions you might have in just a brief few moments. We'll talk about volatilities, options, and any kind of questions that I can help answer so that you can understand this product better and you could find the most compatible option strategy for you sometime to trade in 2009.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.